welcome to Money Magnets Club's webinar on From Allowance to Assets Why Early Money Habits Matter, where we will discuss the importance of financial literacy. And I just want to give a special thanks to our partners, Bright House Financial, Grant Thornton, Ally Bank, Wells Fargo, and Pinnacle Financial Partners. And this is our agenda today. First, we will have an icebreaker. Then we'll go into financial health equaling financial success. We'll discuss why Money Magnets Club. We'll go into financial services information, discussing different products and services and programs. Open it up for Q&A and also have some closing announcements.
Thank you.
And
Appreciate it. Dr. Dillard is the Director of Operations for Money Magnets Club, and I am Dr. Alexandra Arrington, the Executive Director and co-founder of Money Magnets Club, and we're thrilled to be hosting this session today on the important topic of kids' financial health. We just want to offer a disclaimer that this is an informational session. We are not expecting folks to take the information here as an endorsement or financial advice. We do absolutely want to have information for you all to consider and consult with the professionals in your life or professionals you can connect with about what may be the best choices for you to support the financial health of kids in your life. So for our icebreaker, I'm going to turn it back over to Doc.
all right, absolutely. So our icebreaker is two-part. The first question, reflect or answer in the chat. Who or what was most influential in your learning journey with respect to personal finances? And our second question you can start thinking about is at what age did you acquire your first asset? So just take a few moments to think about that, and then we'll just talk aloud and discuss our answers. All right. So I think I have an experience to share for the first question. It says, who or what was most influential in your learning journey with respect to personal finances? I think for me personally, the first time I started considering my personal finances was when I got my first job at around 16. I remember the first bank account that I had was at, I think it was Charlotte Metro Credit Union in Charlotte, North Carolina. And my older sister actually took me to the bank to open up the account. And I remember it really being a uh, kind of a coming of age moment where she was able to share different tips. And I got my first savings card and learning the importance of saving money at that time. So that's how I would answer that first question. I'm curious about some of the other people here today. Angie or Alexandra, what comes to mind when you think of that question?
Oh, I can go. So what I think that comes to mind first is I think I said before I'm a military brat, and back I'm 51 years old. So back when I was growing up, we were taught about work ethics and working really hard, but we weren't really taught about credit, and we weren't taught about savings and budgeting. And so we worked hard and we know how to be morally good people, but we just didn't. I just when I went off to college, I didn't know anything about real finance. And so going off to college, I was went to the University of Tennessee, and so being away from my family, I can remember people from financial industries coming on site on campus and letting us apply for these credit cards. And I was 19 years old and had a gas card from the Exxon, and I had was given a Steinmark card and a learner's card, which was a department store card that I automatically qualified for. I had no job, no income. I had no business with credit cards. I had no idea how to utilize credit. And so I was going up to the gas station with no card, and I was buying potato chips, and I was doing all kinds of things. And coming out that first year, my mom found out I had a credit card. And to them, it was, you don't use credit because it's money you don't have. Right. And so immediately she shut that down, and she paid that card off. And I had messed up one of those credit cards because I was going to the mall and buying clothes at the Learner store and I had no job to pay it back. And I was scared to tell her that I had already maxed that card out. It was only $500. And a 19-year-old who wasn't really taught about financial literacy, once I came out of college and I needed to get my first apartment, that was on collection. And I remember having to pay that off before I could get anything. And that was a huge wake up call for me because I had to go back and clean something up that I knew nothing about, right? And so from that, it was a huge lesson to learn right then about finance. So that was my first experience with why I need to be more conscious of spending money and budgeting money because I had to do all those things. I had to budget to pay that debt off. I couldn't go any further because I had that debt. So it was a huge learning lesson for me. So that was one of my first experiences. And the second part, at what age did I acquire my first asset? And that age was at 27 when I bought my first house. And that was the time I found out I had all those things in collections. And so it all comes full circle.
Yeah, wow. Thank you for sharing, Angie. That is a cautionary tale, but also, something very important that shows the different layers, right, of how important financial literacy is. There are so many things that come to mind when I think of these questions. So I'm gonna try to answer truly what the question is, who or what was most influential. And I'll definitely say the mothers and grandmothers in my life. And in ways that you might think, in terms of traditional financial literacy, and then ways that you might not think, just in terms of lessons learned and kind of adages that are lived out, right? A bird in hand is worth two in the bush, or trying to make a dollar out of 15 cents, right? Those are some things, my grandmothers taught me in terms of both how they live and how they were oriented with money. So I'll give you two quick stories. Some of my earliest memories with my grandmother, my mother's mother, was riding the Richmond, Virginia city buses, and she would always give me the change to put in the bus. 5 and 6 years old, she would hand me the change to make sure I was paying for my fare for the bus. And just even that very small thing, helped me to look at things like agency, or start to orient myself towards agency. And, you do have some responsibility for money that you're given, and you can use it to do things, right, that you need to do. In this case, going to the shops downtown, the drugstores downtown to window shop. So the other thing, my father's side of the family, my grandmother there, something I do still to this day, and I feel like it's such an underutilized, underappreciated skill, is she, from as early as I can remember, anytime we would go to a store and pay cash, she would make me count the change and check before we left the store, did we get the right amount of change back, right? And I think about that so often because now I go to stores where we're in this very highly digital economy, and finance is thought about in terms of what the computer tells you or what the point of sale system tells you. And so often, especially younger people who might be employed there, they can't do that as quickly, right? They can't say, oh, if I say, the bill is 308, right? And I say, here, I have $10 and I'll give you 8 cents. A lot of times it's like, what? Why did you do that? Well, that's so you can give me an even amount of change back, right? And so just these different things that now for me have become part of my everyday thought process. They're not taught the same way, right? There's different orientations to money, as I mentioned, because of the digital nature, but these things have been like very fundamentally shaping, right, how I interact. And now I do the same thing with my children. When we go to the store, I say, check your receipt, count your change, make sure you have the right amount of money. And then always have to give honor to my mother. She started my very first savings account. So when I sign in today to my banking app, It says, welcome, you're a 30-year customer of this particular financial services institution because I had a savings account from elementary school. And so very grateful for some of those early lessons that have been fundamentally shaping the development of financially healthy habits. And so I love this second question too. And I thought also it might trip some people up. I wasn't sure. At what age do you acquire your first asset? And I said, well, how do we understand really what assets are? I know sometimes that can be used colloquially, right, in everyday language, but I think generically speaking, when we're talking about assets, we're thinking about things that add to your net worth, right? Things that appreciate in value over time. And the answer for me is I had the great fortune and foresight of having parents and grandparents who did think about, the future for us, right? And how they wanted it to look for us in terms of being set up for success financially and otherwise. And my very first asset, aside from if you think about a savings account as being an asset, was a certificate of deposit that my great grandmother left after her passing for me to attend college. And my grandfather let me know after she had passed that this was something that she set up for me and that it would be available to me once I turned 18. And it paid for my first year of books at college. And again, so much research out there about how $500 can make a difference in right the trajectory of a child's life in terms of college expectancy, in terms of positive mental health and wellness. And so we wanted to host this webinar so we can discuss more of those opportunities and think more along the lines of how we can better support the young folks in our lives with their financial health. So thank you all for your participation there. Yes, yes, and savings bonds. Listen, so let's get into some of the content for the time today. So this is some of the backdrop, some of the context of why this is even a topic of importance for Money Magnets Club and for the folks who are involved here today. Financial health equals financial success, right? What we know by research is that poverty can span more than one generation. Here in Charlotte, the Land of Opportunity study spoke very clearly about how kids that were born in the 90s that were studied in this particular study in poverty very oftentimes did not escape poverty by adulthood. And that is a tragic opportunity in some ways, if you will, because it's sad if things are not done to help support children to move into a different economic state. But for sure, it's an opportunity because we know that that could be the case. And there are things that can be done in very small but meaningful ways to make a difference. So the Annie E. Casey Foundation cites as of 2022 that 17% of children are experiencing poverty in North Carolina. And I think that figure is, as of then, $28,000 for a family of four in terms of annual income. So think about that. Parents, teachers, mentors. So the question about who or what was influential, we are learning from research as it makes sense, right? Parents, teachers, and mentors are the folks who are the first line of defense, right? About shaping money habits and positive associations with money. And the opposite can be true as well, right? So ensuring that youth have tools that they can access both information and familiarity around, right? So you're not getting a credit card and not really understanding what it is for the first time at 18, right? You get some developmental support with understanding those things and the implications of those things. And finally, what is this notion of financial health anyway, in terms of a frame of reference? Drexel University has a department called the Center for Hunger-Free Communities, which defines financial health as one's ability to manage expenses to prepare for and recover from financial shocks and to have minimal debt as well as build wealth. So there are multiple components to that. And each of those components are expensive, or I'm sorry, are important to the different aspects of this notion of financial health. And, not to get too deep in it, but if we think about, the social determinants of health and 8 dimensions of wellness, financial health is a key component of other aspects of our health, like environmental, like social, like mental health, etc. And so I really appreciate this approach to learning about finances and developing habits as a function of our health, because that I think ups the ante on the importance of it. So really quickly, we would be remiss on this occasion if we didn't talk about what Money Magnets Club is, because our fundamental mission as an organization is to serve as a physical community that encourages entrepreneurship and financial literacy among elementary school kids and their families. And we do that through exposure to different ways that entrepreneurship can look, through education on a variety of topics that approach entrepreneurship and financial health, and resources, because ultimately we want to help young kids and families, particularly in areas of town that are historically divested, that have low area median income, to start to formulate or correct habits that would lend to being able to build generational wealth. And we do that in ways that promote learning, that promote having money. Listen, you can more easily apply financial literacy if you have the financial part, right? So we do provide opportunities for kids to earn money through our programs. And we want to do that in a way that normalizes these types of conversations, these types of activities, and does so in a way that is fun. We have 3 core programs through which we do this work. Our Kidpreneurs in Training program is our signature flagship series that takes kids through a series of activities that helps them to learn about themselves, their interests, to explore how that might relate to developing a business idea. We help them to learn how to budget and learn different ways and different components of budgeting. We help them to explore initially business planning and what that process is like, as well as business ideation, and then finally being able to pitch a business idea and learn how to do that and communicate that in culmination. And they have the opportunity to earn an initial investment for completing a series of those tasks through our Kidpreneur and Training series. So that's super fun. We have our Money Train series, which we do in conjunction with adult serving, economic mobility, workforce development, and other types of job training programs, where while the organizations who we partner with are working with adults, we work with the elementary school children and sometimes older children, depending on the needs of the partner organization. And then finally, we have our Financial Literacy Facilitator Core, which is our internship program, where it's semester long, and we work with high school students as young as in their freshman and sophomore year to develop a strong baseline of financial literacy learning through online activities and self-paced learning modules, as well as through building social and communication skills, as well as social capital by connecting with professionals in financial services and other fields. And all that is coupled with practical application through them earning a stipend to be able to practice what they're learning, as well as being able to share that information with some of the elementary school students that we serve. through facilitated experiences. So we're privileged to be able to do this work, and that is some information about why this topic is of importance to us and why we thought it was important to host this time today. So I'm going to turn it over to our special guest, Angee Taylor from Pinnacle Financial Services, to share some things on some products, some information, and other programs that are offered through the financial institution that she represents. Thank you for being here, Angee.
Thank you so much. And before I get started on some of the products that we offer, I do want to just briefly introduce myself. So good afternoon, everyone. My name is Angee Taylor, and thank you, Alexandra and Doc, for allowing me to be part of Money Magnets this morning and afternoon and bringing this information to you guys. So I love what you're doing. I am super passionate about financial literacy. I've been in banking for about 20 plus years, and one of the biggest passions of mine is financial literacy. Growing up, there was such a cultural disconnect when it came to financial literacy that as I've grown, part of my sorority and also being in for 30 plus years and now being in financial industry in banking, I give back to the community in terms of financial literacy. You know, I feel like each one teach one, reach one when it comes to giving financial advice and just educating people about how important their money is. That's probably going to be one of the biggest relationships they're ever going to have in their life. And so to start at an early age and educating people about financial literacy has been a super is a passion of mine. So I'm just glad to be here today. So with that said, I want to dive into some of the products that we do offer that I think is a gateway into savings. So the first one here is the UPNA, the Uniform Transfer to Minor Accounts. And I'm just going to read that. We see what it is, but it is a custodial account for adults to transfer assets to minors without a formal trust. A straightforward and cost-effective way to transfer assets to minors to responsible management until they are of age. All of that is saying, if you break it down, is anywhere you go, I think people may have heard, and if you haven't heard, a custodial savings account is what they call it anywhere else in short terms of an upfront. That's the politically correct way to say it, but that's just a savings account. And the savings account is structured from the time of birth up until they're 18 years old. And it's a free account that most banks do offer. My bank offers it, but wherever you bank, you can go in and say, hey, I want to open up a custodial savings account for my minor child. The thing about that is that you can start to help them and educate them on what savings is, but they'll actually, and they'll have access to logging in and looking at it, and it's probably going to be one of their oldest accounts and longest accounts that they'll have. But as a minor, the parent or the custodian will have full access to it. The child will never be able to pull money out of it as a minor, but they are able to see the money and the activity that goes in it, and you can have a partnership with your child or minor in watching that grow throughout the years. After they're 18, and it's a completely free account, by the way, so it's tax-free and it's a completely free account for the minor until the age of 18. Then it can be converted over into a regular savings account. And that's the only one account that most banks offer that can be converted if it's in a minor's name. Usually if there's a joint person on the account, there's some legal things that have to take place. But when it's a minor account and it's the actual UPNA savings account, a parent can come off of that account when the child is of age at 18 years old and transfer those funds directly to that minor or custodian that they were custodian over, so that they have full access to the account to pull money out of it. The 529 plans are actually what we call education plans. So 529 plans, when you walk into a bank, you won't be able to just see that on if you go in and ask them for it. But we do have partners in every financial institution that you can sit down with if you want to start planning at an early age for your child's education. That covers both college and private school. And so there's a lot that I could go into about that, but the best place is to check the IRS fact sheet, because it really breaks down what a 529 is, and even some of the tax liabilities. For those who are looking at it, like, there's some tax advantages to it. Because we're in banking, you probably won't get that information from a banker, but you will be able to find a lot of the information on the IRS website. And if you have an accountant, most people who are, entrepreneurs who don't work for a company and they're invested in 529 plans, they already have someone who does their accountant who can give them some of this information on what that looks like for tax liability on the 529, if it's non-deductible. So a 529 plan, in lieu of, we have kids, people gift their kids throughout the years, birthdays, holidays. And for me, I started a 529 plan for my baby girl. I didn't do it with my oldest and wished I had, because they're 11 years apart, and college tuition had almost doubled by the time she went to college, right? And so I had a 529 for my youngest, and what we did is, instead of gifting her at Christmas time, they would gift her money and we would put it into her 529. And that helped so much when she went off to college, because we were paying for books, we were paying for room and board, she had money to live off of. And it was all, it was more than me coming out of pocket, us coming out of pocket, because this is money that she had gotten throughout the years. So a 529 is a definite way to think about savings on top of, the UPMA savings, minor savings, custodial accounts, because that's something that's both going to prepare them for their futures. You want to go to the next slide? Also, I think it was one before that. The savings accounts. So we do have some products that we offer here at Pinnacle, which is our Vision Savings. You can start it off with $500. There's no minimum age to get in this account. It works a little bit differently from your UPMA account, because with this account, once your child is of age, they can actually come in and withdraw from this account, because it's just set up like a joint account versus it being a minor savings. It's just how it is entitling, but they do have full access to this account, and this one actually will never have to be converted. So a Vision Savings, if you open it up with $500 a month, or you maintain a $500 balance a month, once you open it up, it's $500 to maintain a balance every month. If it drops below that, it's $2 a month. That's not bad at all, and I suggest, if you don't start off with just putting $25 in there, if you have a minor that has gifts. For me, what we used to do is tell my daughter she can keep half the money, but the other half she has to put in her savings. And this kind of mentally prepares them to start saving, and then letting her go into a financial institution and know what her account number is, and put it into her savings account, and just watching it grow. Because a lot of times that empowers a child. Not only it fuels them with information and knowledge on how to do banking at an early age, but it also empowers them, because once they start seeing their money grow, it means a lot to them, because they can spend your money, but when they're spending their own money, it looks a little bit different. And a Vision Savings is a perfect way to start that. We also have what we call the Outlook Money Market. That's just a higher yield savings account. Most of the time, if you start that off with a $2,500 and maintain that balance, as if you're in the Vision Savings and you start to see it grow, after a while, if you want to convert that, the good thing is we can convert that account by just mashing a button and changing it into a high yield savings account. So you don't even have to close it out and open up another product. We can just convert the product type. What this does when we say a high yield is it just gives you a little bit more interest than the regular standard savings account. But again, when there is a little bit higher interest, it does come with some other requirements. You will have to maintain a certain balance in order to not pay $5 a month. The Zenith Money Market, and it just goes up from there. So the Outlook Money Market and the Zenith Money Market are identical to what, but the balance for the Zenith Money Market is $5,000. And so the balances go up. So the requirements are what changes. But along with that, the benefit to that is you're getting a higher interest. And because those are set at the market, those rates look different compared to what the market looks like. So the rates could be good at one point. They can be 2% on a money market, whereas a regular savings account might be 0.5. So that's a lot of interest. And depending on the money that you have in there, you're getting more money, more interest back on your money that's just sitting, that you're not utilizing. So those are the differences in the Vision, Outlook, and the Zenith. They're all savings accounts. If you want, and just like the custodial, they're all savings account, and they're all going to be advantaged because it's teaching you how to save, and it's putting money to the side, whether it's for emergency money, whether it's for money that you're setting aside for goal or education, they're all beneficial. And that leads us to certificates of deposits, which they call CDs. So they start off from 30-day CDs up to 5-year CDs, and they can go even longer than that. The good thing about CDs is if you know anything about the market, for those who do know anything about the market, they have rates that are out there, and everybody hears how they talk about how the feds dropped the rates or lowered the rates, or so when they drop rates in the Fed world, it's a good thing for those who are borrowing money, because now you're borrowing money, you're paying lower interest rate. Unfortunately, when you're investing money and the rates drop, it's the opposite, because you're not getting as much money on interest because of the rates are a little bit lower. So, for example, the feds dropped the rates 5 times last year. And we had a CD that started off was paying 5%. By the end of the year, that same term CD was only paying a 3.75, which is a big difference, by the way, especially if you have a large amount of money that's sitting in there, even a small amount of money that's sitting there. That's a significant difference when you talk about 1.5 bonus basis points on the money that you could have been getting, which was the exact same money that was sitting there probably in the beginning of the year. And so if you get a CD kind of locks it in, and you're locked in for a rate. So no matter what the market is doing out there, if you get a CD that's, say, a 6-month CD, or let's go better, a 5-year CD. If you get a 5-year CD and you put money into it and you get a 4% interest rate, 5 years from now, the interest rate might only be 2%. So for those 5 years it's been locked in and you hadn't utilized it, you're getting 5% the entire time. So there are advantages. Now, if you need it, you can withdraw. Sometimes, most of the time, if you withdraw and it's not in grace, it is a penalty. But the advantages is you're getting interest on your money that's just sitting. So I encourage those that are getting CDs, though, and this just being realistic, is it's liquid money. It's money that you don't need to utilize for emergency funds or anything else. And this is money that you want to actually, in actuality, just have sitting somewhere that is going to earn the interest, and you can leave it in for the 30 days or the 4 months or the 6 months or the 9 months. They have lots of term CDs. You just have to figure out which one is the best one for you. But locking it into a CD is a sure way. One, it just trains you not to need it. You have to really need something to go in there and pull money from your CD. It's different from just sitting in your actual savings account. You can just go in and transfer from your check into your savings, or go into a bank and just pull it out. So these products are all structured differently, but they all still are very beneficial, because at the end of the day, you're saving. And that's what it's all about, is saving, whether it's for a rainy day or for something that you're a trip, or those pair of shoes your kid's going to want, or education in the future. It's good to have these in line and understand what they are and start to teach them at an early age. And for the parents, it's good to educate yourself, because if you don't know what these are, I encourage you just to sit down with your banker or give me a call over at Pinnacle, and we can go over, because I wasn't taught at an early age, but I had to start someone. So it goes back to each one, teach one can reach one.
Thank you so much, Angee. That was powerful stuff. This is just by way of a recap really quickly. So, it may go without saying, but for the sake of, not making assumptions, there are a lot of different financial institutions that have these similar types of products. And we definitely want to encourage folks to do some research, compare what might be best for you. And we don't want to understate the importance and the power of relationships with your financial services institution. Bankers, the relationship bankers, the universal bankers, and the different roles that they have there. Having a relationship can make all the difference in having an advocate, having another person that's also looking out for your best interests in terms of the products, the services, and the information that may help you meet better your financial goals, as well as that you may have for the young folks in your life. So the custodial accounts, the UTMAs, you have the 529 plans for education savings, and Ms. Angee mentioned the different vehicles that Pinnacle has. There are two other types of accounts that I just want to share some very brief information about, but more so to encourage you to check out our resources and references page. This recording and this deck will be made available subsequent to this recording. But ABLE accounts are investment accounts that for folks who have income restrictions. That is an opportunity if you're worried about, oh, I might be on a fixed income, or I'm not sure what the tax liability might be, or, I'm receiving government assistance and I, don't want to run afoul of the rules there. These types of accounts exist for folks who might find themselves in those circumstances, as well as those for individuals with special needs. So special needs trusts are vehicles that can be set up to have someone to be appointed, the person to make decisions on behalf of supporting someone who may have special needs that may not be able to make those types of decisions on their own. So want to shout out the references section to be able to give you some more resources to continue the learning journey around supporting youth financial health. Some other things in terms of services, I won't read out everyone. These will also be in our references section, but if you are looking for free, everybody likes free. I always say free is not really free, but definitely we talk about you not having to come out of pocket for the cost. Financial planning, the Association for Certified Financial Planners is something that exists where you can make a request to have pro bono hours from a certified financial planner. Again, sharing a resource at the end of this session about how to take advantage of that. Most of the time, we talked earlier about the financial services institutions that you may bank with, having financial advising as a part of the function of the bankers themselves. There are also at-cost opportunities to have the service of financial advising if that's something that you want to start to plan for in terms of your budgeting and saving. Same thing with the credit reporting. You can receive one free credit report per year. And we'll add that official link for the references page. You should always be checking to see, do the things on the credit report align with what you know and understand about how you're using credit? If you have it at all, maybe you're starting your journey, you want to know what's out there, what the bureaus are reporting on you, but also your relationship bankers can help you oftentimes with sorting through that information and access to the credit reporting there. Pinnacle also has economic empowerment resource centers as well as the local initiative support cooperation. Here locally has the Financial Opportunity Center that is run in conjunction with the Charlotte Area Fund. These are actual spaces, they're physical spaces where you can go in where you may not maybe feel as comfortable talking, with a banker per se, but you may want to have an environment where there's a little bit more emphasis on your specific needs, your specific goals and plans, and where you can get a variety of types of information that may support what your goals are financially. These are a couple options around that. And then finally, want to point to Commonwealth Charlotte's trauma-informed financial counseling. So they have financial navigators that you can speak with and have one-on-one opportunities for them to sort through a variety of things, like what your experience has been with money, like what are some of the logistics, right, about how you're using money, what are your problems, and how might you work with them to develop a plan to help to bring solutions and resources to the problems you might be experiencing with money. But they really are focused on how did you get to where you are with it, respect to some of the mental, psychological, and emotional components of using money, right? And how has your socialized experience maybe contributed to what you might be experiencing with relationship to money, and how you can move through from where you are to a better place, and have that grow over time. So really great resources that exist here. Again, please be checking the references and the resource page. So we did have some time as we're winding down on the webinar for discussions, for questions, for feedback. And I'll kick us off because I had one question. I recently was talking with someone, and Angie, I'm going to direct this question to you about certificate of deposit ladders as a strategy for saving and kind of getting the best use out of some of the interest rates for CD ladders. Are you familiar with that? Are you able to speak to that at all? And if not, I could just talk about what I was told about it.
Yeah. Well, it depends on what avenue you're looking at when you're asking about the CD. So what is it in what information are you looking for when you're talking about the CD? Because the CD product, for me, I think is a good option, again, for those who have liquid money that it's not their savings and they're wanting to tie money down for a certain amount of time, whether it's 6 months or 3 months, 4 months. A lot of them start off 30 days. 30 days to me is very short term, but 30 days is if you're making a bigger decision on what you're going to do with your money, but you want to get some interest, I would suggest a 30-day CD because I've seen that on the when it started off. But locking money in, you have to, again, I just have to reiterate because I see people a lot of times in this industry, they come in and they have the intention to save, and it's a good thing, and they lock the money in, and the rate is awesome. But then they end up, for whatever reason, because they didn't have liquid money and they put all of their money into the CD, that they end up having to come in and withdraw from it, which kind of hurts you because you're pulling and you're getting penalized for using your own money. Even if sometimes it's minimum, it's defeating the purpose of having it locked into a CD. So sometimes you just got to gauge which is the best avenue for you to take. Should you be putting it into a CD or maybe or something that's more open, like a money market? And so I always guide people like, know your financial banker. When you said relationships, it's looking at your financial picture and actually seeing what it is that you're trying to do and help navigate you to the best product and service that we offer, regardless of what financial institution you're in. So, and I just have to say this is not what you asked, but I have to say this because working in this industry, I don't think people realize that the reason we have jobs is because people keep coming in, right? And so if you don't have the relationship with your banker and you're not utilizing them, I tell people all the time, when I said your financial relationship is the biggest one you're ever going to be in your life, is because it's going to follow you throughout your life. You're always going to need money for something. So you're going to always need to understand how to budget your money and how to spend your money, right? And how to make your money make money. Those are things that are just, you're going to have, that's going to follow you from the day you're born, really, until you die. You're going to need it for something. And so, if you don't have anybody in your bank that you have a relationship with, and I make this analogy all the time, if you're in a relationship with somebody, because the bank is your relationship, that's who holds your money, right? If they haven't called you to check on you, to see how your bank accounts are doing, or if you have any short-term or long-term goals they can assist you with, if you have money that's sitting there that could be utilized in a different type of way to earn you more money, then why are you with them? Because you wouldn't be in a relationship if you had these are for the older people. If you had a girlfriend or a boyfriend and they weren't calling you, they weren't checking on you, and you were with them for X amount of years for whatever reason, and you didn't see the relationship growing, you wouldn't still be with them. So I say the same thing about your bank. If your bank is not calling and checking on you and making sure that things have changed, because year after year, it's just like you go to the dentist and that tooth was fine, and 6 months later you go back and now you have a cavity. It's the same thing with your finances. You don't know nothing is wrong, or you don't know something is wrong until you actually sit down. Especially those who have had accounts and you think my account is fine, if it's not broke, I don't need to fix it. But here's the thing is sometimes you can have an account that's 30 years old and you were set up in an old grandfathered account. And what they call that grandfathered is you were paying a service fee then that's maybe $10, and now they came out 10 years ago with a product that's different, but because you never talked to anybody to change it, your bank account stays the same. And now people are getting better benefits than you, and you have been had this account for a really long time. So it's just about sitting down with people and understanding what your financial picture looks like. Are you set up in the best account now? Are you getting the most for your money? What goals do you have? Is it better for me to put my money in a CD or leave it in a savings, or put a portion in a CD and leave some in the savings? What is it going to look like to get my credit? So those are things that we can help you with. And it's not just financial advising. These services are free in every financial institution, right? And we call it financial advising, and some people are actually paying people for this, but inside your bank, that's your relationship, and they should be doing it for free. So I'm sorry to go on that whole thing, but I need people to understand the importance of what banks really are there for, because they're not just taking your deposits and cashing your checks. They should be doing a lot more.
Yeah,
Um,
same advice. I appreciate you sharing. I think the context of the CD ladder that I was in conversation about is that, to your point, that it may fit into your overarching strategy that does need to be fleshed out with a professional to help you determine if it's something that would be useful to you or not. But it's the idea that, you may have a sum of $5,000 or whatever it might be. And because, interest rates might be spiking on a particular, length of time, in a good way that you could hold money, you have one for 3 months, one for 6 months, one for 9 months, where it can also ensure, you're getting good interest rate, but you're also having access to that funding without penalty, at some regular interval. So you're getting an advantage of the interest rate that might be a promotional offer at the time, but also you're not necessarily locked in for these very, very long times for money that you can't get to if you think you might need it. But to your point, I definitely agree. Your strategy, what your goals are should really underpin what things that you're doing in the financial services space for sure. One of the things I wanted to share and also, invite your feedback on, in my experience, there's another, back to our icebreaker question, there's another figure that really in my adult life looms large in terms of how I navigate financial services and how I determined to be a client of particular financial services institutions. And typically I'm not naming specific names, but I'm naming a name today because Jamie Dimon is the CEO of Chase Bank, which I think is the largest bank in the world in terms of assets under under their purview. To the tune of trillions and trillions, and that's significant. And I had the opportunity to hear him on a panel once, and what he shared was like fundamentally shifting in how I think about my relationship to financial services institutions. And basically, he was talking about, they offer, all these different incentives. You can earn $500 if you open up a new account for the first time, or, we can do all these great perks on the different credit cards that we have for points or miles or this or that or the other thing. And he wasn't just bragging on their products or services because everybody has, every bank has, similar products or services. What he was saying was the reason that we can offer, such high perks comparatively perhaps is because they are essentially banking on people like defaulting on their credit cards, or they're not paying back their credit cards in a timely manner, and they're incurring these fees and different things. And so it really, I don't want to suggest he was being nefarious. He was very much just talking about what the facts of the matter are. But to me, that there was two things I took away from that learning how to use these products to your best advantage is so critical in navigating financial services and navigating our financial systems, number one. Because again, there is so much opportunity to fall into a pit and really kind of be mired across the board with making poor financial decisions. But on the other side of that is because there's essentially rules to the game, you can use those same rules, right, to benefit yourself, right? So one of the things I do, like if I have a sum of money that's for, short-term or mid-term savings, I'm going and I'm doing comparison. Who is giving the highest rate now to the highest incentive to open up a new account? And what are the time length requirements? And what's the minimum balance requirements? And I'm doing that. I don't have to stay with this one bank because, that's who I open an account with. I don't have to stay with a huge commercial bank that doesn't offer as competitive rates as maybe a credit union or a smaller bank, right? I don't have to stay with a bank who I don't have, I'm not able to get anybody on the phone, or I can't talk to anyone on a first name basis. And I think that's something as consumers that we need to really think through and adopt and create that mindset for kids, right? We have the buying power, like Angie said. The reason that there are banks is because we put money in there, right? And
100%.
consumers, we have a lot of power, and being able to exercise that power is really it can be really fundamentally shifting in how we navigate the opportunities, make the demands, and have the financial systems work for us. So I'm just offer that up.
Yeah, I'm glad you said that, because the thing is, I don't want you, when I say that our banks, obviously I've been in banking for 20 plus years. And what I will say about this, and this is just being completely transparent, we're for profit like anybody else. So obviously there are going to be some things like if you have a free checking account, then you don't have to maintain any balances at any time. But there might be some requirements that come along with that. You might have to pay for your certified checks. You might have to pay for your money orders. You may have to pay for regular checks if you want to order them out of your account. But if there's products and services to fit everybody. But again, all banks are for profit. That we're a business, and so there are fees that come along with loans. I'm not going to say that we look for them to default, because what happens is, if people default on their loans, then essentially, what if everybody did that? And that's just like me giving money out of my pocket and my friend never paying me back. So the person that's left empty is the person who gave it. And so we're not really looking for them to default on their loans, but there are things that happens when things like that happen. What I also will say about banking is, um, when they put out these things like $500 for the checking, if you open up a qualifying checking account in this, people don't read the small print, right? You might have 90 days to have a qualifying direct deposit of X amount of dollars, and you have to use your debit card X amount of times. You're just thinking and looking at the incentive portion of it, and you're not looking at the overall picture of what are they really requiring you to do. Read the small print on some of those, because I'm guaranteeing you that there are some things that go along with it as requirements to get that money. And what I've found is I've seen people who open up those accounts to just get the incentive. And then they don't really utilize the account. So then now you're just running around with money spread out everywhere. And either if you don't have that kind of money to be spread out everywhere, then you're really doing it for the incentive. Then what real value is that for you as a consumer, right? And then back to relationships. We have a 3-ring rule here. We have to answer the phone in 3 rings. That is a policy. It's not like if you call any Pinnacle branch, I don't care where it is, Tennessee, Virginia, Atlanta, Alabama, they're going to answer the phone in 3 rings. Somebody in your branch. And that is huge. As opposed to calling and getting a call center, somebody who doesn't know you and somebody who is not going to pick up the phone, and you're just an account number, you're just another person that's having a problem on the phone for somebody that is never going to touch you, right? So when it goes to relationships, we are very relationship focused. I can't speak for another bank, but I have worked for smaller banks and I've worked for bigger banks. And I can say that a lot of times we get so technology based that we want to get you in, and we want to get you in every product, and we want to sell you this. And then we get you out the door, and we don't ever see you again until there's a problem with your checking account, but we don't want it to be a problem. We want to grow with you, because if you're not growing, we're not growing. And so I encourage people to keep that in mind when they're thinking about, like, listening to the big Chase and seeing the convenience of having your Bank of America or Wells Fargo everywhere. Sometimes it's just not convenience. People don't want to go through changing all their banking stuff over. But now things are so technology based that you can just mash a button, log into your other online banking, and we can navigate everything and have all your direct deposits, all your bills that are set up, all your reoccurring things rerouted. People don't normally break up with their financial institution until something goes wrong. And you don't have to wait till something goes wrong. If everything is going right for you, but you don't see yourself growing with them, you just need to rethink how that relationship looks overall.
Awesome. Quick shout out to other institutions, either that are digital first or digital only, because those are also options. There's some online banks that's, in a day and age where digital is so important, sometimes the younger folks are looking at that. Sometimes there's better rates because it may not be a physical branch that you can walk into. Again, not endorsing, not saying one thing is better than the other. I'm saying it's an option. And also to the credit unions, which are nonprofit financial institutions, there are different benefits or advantages and different things you might not be able to get at credit unions because of their different structure and orientation, but that for sure is an option. Want to make just a quick couple announcements before we wrap up here. Hopefully this information has been helpful to you today. And if it has, we'd love to see you at other upcoming Money Magnets Club events. We have our summer Sip and Sense fundraiser coming up on July 14th. You can stay tuned to our website, moneymagnetsclub.org, for more information about that. If not, this topic of nonprofit financial health is important to you, or you'd like to learn more or delve deeper in particular aspects of it, we love to hear from you and to create some opportunities to work with your populations of service or create some event around that would be useful to you, as well as we have the opportunity to develop formalized partnerships. We have worked on our partnerships process and would love to talk more with different organizations and institutions that find this mission of ours, as well as the pursuit of financial health, particularly for kids, important to learn how to better work together. With that, just want to put up really quickly that references the resources page that we spoke about earlier. We'll be adding a couple things, and then we'll have this information in the deck and the webinar available for consumption after the fact. And we want to thank Ms. Angee and thank Doc for joining us to help facilitate this time in this session today. And you all take very good care.